Welcome to another episode of the Practical Wealth Show. And so I am very excited. You know, one of my goals is to help you guys win the war against the IRS so you can I help people keep more of what they earn and earn more of what they keep. And your number one by far transfer of your wealth is the taxes.
Sure.
And and so most business owners think filing taxes is the same as having a tax strategy. It's not, right? So today I'm talking with Ed Lyon about why successful business owners still overpay the IRS, and how do you know when you've outgrown basic planning and what to do about it. Ed, tell me about yourself. I was going to read your bio, but and welcome to the show.
Well, thanks. It's a real pleasure to be here, and I'm looking forward to having this conversation. So, I am 20% lawyer, 20% friend, 20% psychiatrist, 20% financial advisor.
Okay.
And I haven't figured out what the other 20% is. But I have spent 30 years in the tax space. I've spent the last 21 years primarily helping CPAs and financial advisors learn how to do tax planning. You mentioned the number one transfer for most high income people is not to their life insurance, it's not to their retirement plan, it's not to their mortgage company, it's not even to their kids' school, it's to the IRS.
Right.
And if you're looking to play financial defense, which is what tax planning is, it makes sense to start with the biggest expenses. I mean, sure, you can save 15% or more on car insurance by switching to Geico, but what's that really going to do for you in the long run? If you're a high 6 or 7 figure earning, it's not going to make much difference. So I help successful people pay less tax so that they can spend that money on something they want instead of something that a bunch of politicians in Washington, D.C. have decided to spend it on.
Right. I always tell people I think you're a better steward of your resources than giving it to some politician you never met, or even me. I'm some fund manager you never met either. Right.
Right. So, right. And I've met the politicians and I've met the fund managers. I still think that I'm a better steward of my own money.
Yes. Yeah. So let me start with this. I want to set the frame for this conversation. So what's the difference? Let me say one thing. So what is a transfer? Transfer means money's leaving your checking account going to someone else's. So it's leaving your checking account going to the Treasury Department. So that's what I mean. And then what you have to look at is what people it's not just the money, it's the money at opportunity cost. So at interest.
Right.
And
right. It's what you could have done with that money. If I waste $1,000 that I don't need to pay on taxes and I send it to the IRS, that money is gone forever. Whereas if I keep it, now it's under my control and I can invest it as conservatively or aggressively as I want.
Yep.
And I'm going to have the growth. So 10 years down the road, I don't just have the $1,000 I didn't send to the IRS. I have the $2,000 or $3,000 that it's grown into. And if I invest it tax efficiently, then all $3,000 of that is mine. I'm not going to have to send $500 of the growth to the IRS.
Right. That's what I'm talking about. So let's frame this. So what's the difference between filing taxes? Because people say, well, we filed, my attorney handles this, they asked for my paperwork, and they file it. And here's what you owe, right? And actually having a tax strategy. Don't you call them like red light?
Right. So filing taxes is recording history.
Right.
You take your income, your expenses, your statements, your W-2s, your 1099s, your stack of charitable deductions, and you or somebody else compiles that information on a tax return. And the goal is to put the right numbers in the right boxes on the right forms and get them filed by the right deadlines.
Right.
That is important work. It's necessary. It's something that every American has to do. And we can debate why it's so complicated and what we could do to make it less complicated. But the reality is, filing taxes is recording last year's history. A tax strategy is something that you do now to change the future. So if I have $1,000 to invest and I put it into a taxable brokerage account mutual fund, the mutual fund is going to throw off capital gains distributions at the end of the year, and I'm going to pay taxes on them even if I've lost money in the fund for that year. That's why I don't buy mutual funds in taxable accounts. They are the only place in the tax code where you can send the IRS money on an investment that lost value, versus taking that same $1,000 and investing it in permanent cash value life insurance, which I will describe as a Roth IRA that got bitten by a radioactive spider.
Right.
No taxes on that investment. So what I've done with that strategy is I have said 10 years down the road, when that money has grown, I'm not going to include that growth in the stack of papers that I give to my accountant. In fact, I'm not going to report anything to the IRS. If I put money in an IRA, the IRS wants to know what the value of that IRA is at the end of the year. And you get a form that tells you the value, and the IRS gets it as well. But there's nobody reporting the cash value of your permanent cash value life insurance. So a tax strategy is changing the way your business is taxed. Right now, you're a sole proprietor, you're paying income tax and self-employment tax on every dollar of income, but you're growing. So you change. You say, I'm going to take my LLC and I'm going to make an S corporation election, and now I'm going to cut my employment tax. You look at your living situation. You're living in a rental. You buy your first home. Now, if your mortgage interest is enough, you'll be able to deduct that from your tax return. A tax strategy is proactive activity now to change your future history.
That's so. Why don't, let me put it, that's awesome, because I think most people, they're historians and they don't, like I tell people, if you're not meeting with your person at least like 3, if not monthly, 3 times a year, you have a tax preparer.
Yeah, and most business owners and most high-income individuals have a tax preparer. And again, that's important. CPAs tell you how much you owe. That's important. It's just that most of them don't tell you how to pay less.
How to pay less, right. And so is that why, do you think successful business owners still are overpaying their taxes?
That's the biggest reason, because they don't understand the difference between tax preparation and tax planning. Most CPAs will make so here's what most CPAs do, and I'm speaking very broadly here. So if you're a CPA listening and this isn't you, don't get offended.
Right.
But what happens with most businesses and their CPA is, towards the end of the year, in October or November, the owner sends the CPA their P&L for the year, and the CPA does a projects what the final number is likely to be at the end of the year, and then looks at that final number and says, okay, here's how much you're going to need to send the government on January 15th in your final estimated tax payment. That is a compliance responsibility. It's projection. It's not planning. A lot of CPAs call that tax planning. We're going to plan on how much you need to send. No, you're just projecting this year's numbers. And then the client looks at that number. I had a conversation earlier today with a client who looked at that number and it was $830,000 and said, how can I pay less? And typically the accountant will have a couple of suggestions. One is throw some money in a qualified retirement plan. Yes. You'll get to deduct it. That's sometimes good advice. Often it's terrible advice, because you're just kicking the can down the road. You're still going to pay the tax down the road. And in the meantime, you're going to have locked up your money in a retirement plan where you can't get any use out of it now. The second strategy that most of these compliance-oriented CPAs are going to suggest is buy a truck, buy some equipment, buy some computers, buy some improvements to your office space. You don't have to pay for it this year. You can put 10% down on the truck, but you can still write off 100% of the purchase price. Right. And that is sometimes really good advice. The problem is it's not enough. So when I sit down with my clients, I've got 50 different strategies, not just two. It's a much broader universe of strategies. And for me, what makes it an art rather than a science is matching the right strategy to the right business circumstance. For example, let's say you are a business owner, you own a business, you get to the end of the year, your income has gone up, you've got a big tax bill. The CPA says, well, you can put $200,000 in a defined benefit pension plan and you won't pay tax on that $200,000.
Right.
But you got to ask yourself, what was I going to do with the after tax amount that I would have been left with if I had paid the tax? So let's assume this business owner's in the 35% bracket. A $200,000 defined benefit plan contribution would save them $30,000. They would have $130,000 left over. Well, what are they going to do with $130,000? If they're going to buy equipment, if they're going to buy something, if they're going to buy inventory for their growing business, well, putting the money in a defined benefit plan locks it up where you cannot do that.
Yes.
Also, taking $200,000 off the taxable income, if your business needs to borrow money, you have just made a material change in how you look to a bank. So it may be that in order to remain bankable, you can't do that. It may be that if you're a franchisee, in order to comply with your contract with your franchisor, with your franchise agreement, you need to show a certain level of profitability. So there are lots of reasons why that conventional CPA tax wisdom at the end of the year either isn't enough or isn't the right strategy. And so that's where tax planners come in. We aren't just looking at a menu of strategies like a menu at a Chinese restaurant and picking one from column A and matching it with two from column B. We've got to really figure out how to accomplish the client's goal. So this is what I say at the beginning of a lot of meetings with clients that surprises them. I say, my job is not just to help you pay less tax, because paying less tax can get in the way of your other goals. My job is to help you accomplish your financial goals with a minimum of interference from taxes.
I love that. So it's really and we full disclosure, I went through how was that? 2.5 day program in Dallas last fall, becoming a CTBA, certified tax business advisor. And that was when you talked about and holistic. Like, it was funny because we're going through the workbook. You start doing those 50 things that can be done. And I was checking them off. How many have I heard of? And I was paying for tax planning, what I thought was tax planning, right? And I heard of like 4, that I had. And so there was another 45 I'd never heard of. And everything is not for everybody. One of the things that we talked about was that you're not just going to come with the strategy du jour. It's like, okay, there's probably 8 things that you could do, and we're going to pick
right. Yeah, we're going to look at a bunch of them, and we're going to see which ones are the best fit. So the tax reduction space is pretty full. There are a lot of people who have something about tax reduction on their business card, if they still carry a business card, if they're pterodactyls and dinosaurs. But there are lots of different ways to approach tax reduction. There are a lot of people, I call them hitmen. They have one weird trick that melts taxes away. And they may be very good, legitimate tricks and strategies. And we work with the hitman when the hitman strategy is appropriate for our client. But if you're a hitman, you're a hammer looking for nails. You're going to talk to people, and if they can't use your solution, you're going to move on to the next one as quickly as possible. The way I do tax planning, I work with all 50 of those strategies. So it is top-down, holistic. I am the architect of the client's tax plan. So when I work with you, Curtis, when I work with somebody like you, you are the general contractor. I'm the architect. And when we bring in the hitmen are subs. They're subcontractors.
Right, right, right. I love that. Why do you think I'm not beat up on CPAs? I'm gonna move from that, but why
Mhm.
don't CPAs bring strategic? Because people think that's what they're getting if they get a CPA, right? Why don't CPAs bring strategies proactively, in your opinion?
Because there is a deadline. There's a tax deadline. April 15th, the returns are due. June 15th, the estimate is due. September 15th, the estimate is due. January 15th, the estimate is due. There are sales tax returns, there are payroll returns, there are excise tax returns. The nature of the tax system pushes people into short term thinking to meet all of those deadlines. You and I, Curtis, we're not short term thinkers, we are long term thinkers.
Right.
That's the fundamental difference.
Interesting. Okay. And so, let's go back to the qualified plans, because I always tell people qualified plans do two things. They defer taxes and they defer the calculation, but the more accurate word is they postpone taxes and they postpone the calculation of those taxes. And, if I'll ask clients at the beginning, I said, listen, in the future, I don't really love retirement, but I said, do you want to retire on what you're making now, more than what you're making now, or less? Nobody says less.
Nobody says less.
Nobody says less, right? So that means if your income doesn't go down, you're not going to be in a lower tax bracket. If you
Exactly.
say you're going to be poor, you plan on being poor? I mean, that's what
Right.
you're getting indirectly.
Yeah, the conventional wisdom in this country, let's call it the 401k industrial complex, is that you're going to feed money pre-tax into this account during your working years when you're in a higher tax bracket. You will then retire, your income will go down, you'll be in a lower tax bracket. So you don't really save anything up front. You save money down the road if you're in a lower tax bracket. So let's look at a couple of problems with that. And I could talk all day long about the problems with that. The first is, what are you spending the savings on right now? If the savings themselves are actually going into the account, great. If you're spending the savings to upgrade to a fancier truck, to the $90,000 truck instead of the $60,000 truck, or the $600,000 house instead of the $500,000 house, if you spend your tax savings now, you find yourself really behind the eight ball when it comes time to pay the taxes. Yes, they'll come out of your account, but they'll reduce the return that you get in the account. In the account. The second thing we need to talk about is, last month we just hit $39 trillion in national debt. We hit $38 trillion 5 months before that. We have a presidential administration that wants to add $600 billion a year to the Pentagon budget, and they're willing to cut $200 billion a year in discretionary spending to fund it. I went to law school because there was no math. But when I look at that, that means $400 billion more deficit every year moving forward. So you just said a couple of minutes ago, you ask your clients, do you want to retire on less money, the same money, or more money? Nobody says less.
Right.
I'm asking you now, when you pull your money out of that retirement account, do you expect the tax rates are going to be lower, the same, or higher? And once again, nobody's going to say they think the tax rates are lower.
That's right.
So you may be in the 37% tax bracket. You may be thinking that is the highest tax bracket of all. So I must be getting a good deal if I'm deducting the money this year at 37%. Well, you're not going to feel so happy with yourself if 20 years down the road, you're pulling money out and you're paying 45 or 50 cents on the dollar when it comes out. And that's before we even get into the fact that qualified retirement plans turn capital gains into ordinary income. They turn qualified corporate dividends into ordinary income. There's no stepped up basis at death. There is no buy, borrow, or die. The New York Times editorial page this morning had an interview with an estate planning law professor talking about what she says is the single most important key to why rich people don't pay taxes. It's called buy, borrow, and die. If you choose to put your money in a qualified plan, there's no buy, borrow, and die. There's just die and somebody pays. If you haven't paid the tax, your kids will pay the tax. And by the way, your kids may be in a higher tax bracket than you because they're probably still working when you die.
Right.
Also, so there's that. But permanent cash value life insurance as a supplemental retirement savings plan, it's all built around buy, borrow, and die. Right. So you're taking a strategy that the Warren Buffetts and the Elon Musks and the Jeff Bezoses of the world are doing, that this estate planning professor says is the key to why they're not paying their fair share in taxes. And you have a way that you can take advantage of it yourself. So the planning that you and I do, we're democratizing buy, borrow, and die.
Right. Okay. I love that. So how do you know, or how does one know when they have outgrown basic tax prep?
If they're in pain over their taxes, they have probably outgrown basic tax prep. Certainly, if somebody owns a business and they're making more than six figures in the business, they may not be an appropriate client for what I do because I work at higher levels, but they have outgrown basic tax prep. And it's time to sit down and have a conversation with their tax preparer and say, are you also a tax planner? Maybe they are. Right. Probably they aren't, but there are more and more people who are getting into the planning business. When I started Tax Coach Software in 2005, we were the only game in town, and I got a lot of people into the tax planning business. Many of the people who now run tax planning organizations started their tax planning career as part of my group.
So it's funny, a lot of the people, I'm not going to name anybody, but that you see on YouTube or Instagram, they're from the tree of
right.
Right. You know, at some point, right? It's like the coaching tree of,
right.
You know, and let me ask you, so what level should trigger strategy thinking? Income level should trigger strategy thinking?
You know, for most people, if they are earning discretionary income that they don't need to spend, that's something that they can use for a tax strategy. If you are making a decent living, but you're living paycheck to paycheck, tax planning can be valuable if you're not sending money to the IRS. Right. Maybe you can start building up your 6 months emergency reserve fund that we know everybody should have, but that most people don't. There's no hard and fast line. I've done tax planning for business owners who aren't making much now, but we know that something is going to happen with the next couple of years and it's going to explode and they're going to be making a lot of money. They're grateful when they know what they're going to be doing about that tax problem before that tax problem actually hits them. I will tell you that I'm in a Bentley business. I sell Bentleys, and I don't apologize when somebody comes to my showroom with a Porsche budget or a Camry budget or a Ford budget. Those are great cars as well. It's right. Just not my market. So I'm typically talking with people at a minimum of $600,000 a year of taxable income to get them into the 32% bracket. Most of my clients are $1 million or above. But it doesn't mean the tax planning is not a valid opportunity for people who are making less.
Okay. And so that's, see, because you're it's different levels of pain, right? But you still need more than a tax prep person, right? Because there are things that you can do. And,
right. And a lot of people, I mean, H&R Block is never going to do tax planning. Jackson Hewitt, anybody who advertises for a quick refund or refund anticipation loans, they're not doing tax prep. Right. Liberty with the Statue of Liberty blowing around, twirling the signs outside the mall on your drive home. That's not tax planning.
And if you're, let's say, W-2 under, I don't know what, 150, 200, 100,000, you You could use some tax plan. You need to look at your stuff differently.
You need to look at your stuff differently. If you have a significant amount of income that's being taxed at 24% or higher,
Yeah.
meaning for most married couples, a couple $100,000 in taxable income, then there are things that we can do. There are more things if you're a business owner, but a lot of W-2 earners don't understand that there are things they can do. And a lot of CPAs don't understand how much a W-2 earner can do in terms of planning. So there are two primary lines of defense for tax planning. For business owners, most of them operate their business as a pass-through entity. That means that they don't pay tax at the proprietorship level, the partnership level, or the S corporation level. They file an entity return. The entity return has a bottom line number, and you report that bottom line number of income on your personal return. So if you're a business owner, the first line of defense is, what can we do to get that number smaller before it hits your tax return? CPAs tend to focus on the business owners because, frankly, in good faith, they can do business with business owners. They can do accounting, they can do payroll, they can do business tax prep, but most CPAs who are working with business owners want to get them on a monthly maintenance fee, a year-round retainer, so money's coming in every month, and they can do that. With a W-2 employee, they don't have that opportunity. They got one shot a year to charge them for a tax return, and it's not that hard for W-2 earners to comparison shop and see what the fee is going to be for the tax return. They're going to likely look for a less expensive source. But there are things that you can do at the 1040 level once the income has already hit your 1040. Doesn't matter if it comes from a business, doesn't matter if it comes from a W-2, doesn't matter if it comes from pensions and IRA income. There are things that you can do at the 1040 level to create deductions that offset the income that hits their 1040. And most accountants working with W-2 clients, A, they're not aware of those strategies, but B, they would rather work with business owners because business owners are more profitable clients.
Could you name 2 or 3 on both, like easy ones that I don't think most people
Sure.
have heard of?
Well, I think the people in the tax reduction space love to talk about the Augusta rule.
I was thinking
The Augusta rule says that if you rent your house to your business for up to 14, but no more than 14 days per year, to host legitimate business functions, to calculate a legitimate defensible rent, to document those occasions legitimately and properly, that's a terrific way to reduce the amount of money that gets passed through to your 1040. So that's a level 1 defense. A level 2 defense might be charitable deductions. It might be setting up a charitable trust. It might be a leveraged charitable donation program. It might be a side business that loses money. And we see a lot of people who will set up an equipment leasing business. They'll buy something like a truck and put it on a Turo rental platform. Right. And the income from the business pays for the truck, but they get to depreciate the truck up front, and that offsets their W-2 salary incomes. Now, there are various statutory limits. There's something called the Section 461 excess business loss limit that I'm just throwing those words out there to scare people. Right. Not because I expect you to understand them. Right. So that's why this is planning that is best suited for a human being. Don't take Section 461 excess business loss limit, throw it into ChatGPT, and expect ChatGPT to be able to spit out a plan for you.
I always tell people you can't let IG or YouTube be your financial advisor, right?
No. Well, if you have ever gone to WebMD.com and plugged in your symptoms, WebMD is always 100% of the time going to tell you that you have contagious death cancer, and that the only thing you should do before going to the ER is make sure that your will is in force.
Right? Listen, that's not even a joke. One time I had like a sinus headache, and it was like, you could be having an aneurysm. You have
Right,
but
right.
right,
Just be
and
sure you're not.
right, and I went to see my doctor. He's had a sinus headache. He did something for it, and really, just need to take a hot shower to open up my nostrils, and boom, he gave me some painkiller and something like an antibiotic, and it started to resolve itself. But if I listen to chat, that's why I tell my daughter. She's always on ChatGPT, and she's been like a hypochondriac since 13. So in her mind, she's always gonna die. Yeah, I say, look, stay off
Right.
the internet. And so I think it's the same thing.
Stay away from the internet.
Yeah. So let me ask you this. So now we talk about the magic question, right? Magic question, right, is when was the last time your CPA brought you an idea to reduce your taxes? Why is that powerful?
When's the last time your tax pro came to you with an idea to save money? And I've been asking that question for 20 years. And if I had $1 for every time someone said never, I'd be retired myself. And I would be retired pretty rich.
Yeah, exactly. And because they'll laugh.
Yeah.
Never, right? Well,
yeah,
okay.
Never.
Usually it's never. I don't think I've had anybody say yes. Okay. Yeah. And so that's interesting. So that's one of the things. So ask yourself that, because if that's a never, then I would say you might want to, reach out to so I'm the what's the word? I am the entryway to Ed. Okay. So you reach out to me. I'm the what you call me? I'm the EMT.
You're the general contractor.
I'm the general contractor.
You're the general contractor. I'm the architect. And then the various strategies, we have subcontractors who implement them. So the subcontractor might be a company that organizes an IC disc for a business owner who exports products. Mm-hmm. The subcontractor might be an engineering firm that does cost segregation studies. The subcontractor might be a life insurance company.
Yeah. So it's a lot. So like to me, if you think holistically, I see taxes part of a bigger problem, because we take people through, we look at cash flow structure, liquidity, protection, and if they aren't coordinated, you can still lose money, right? And the framework that we approach, finance is that there is actually more opportunity to minimize your losses than there's trying to pick the winners, right? Mm-hmm. So if you got a bucket that's got holes in it, we try to plug the holes. And most people are trying to grow their top line revenue. You got to do both, but you got to plug the holes first, and that's where tax planning falls, because that's your biggest expense. What does it cost for someone to wait too long to have this conversation?
Oh, billions of dollars. No, that's an exaggeration. We'll go with the Dr. Evil answer, $1 million. I have no idea how much it's going to cost them. But it can be thousands, tens of thousands, hundreds of thousands, or even millions, depending on what your starting tax bill is.
Yeah. Who should be paying attention right now, even if they're not ready for the most advanced strategies yet?
If you wrote a check to the IRS this week on April 15th and thought there's got to be a better way, they should have that conversation with you.
I love that. Yep. And for someone listening who realized they've never had this conversation, we just told them, what should they do? I was thinking what should they do next, but reach out to me. Mm-hmm. Start, right? What I got a minute or two here. What didn't I ask you? If this is my catch-all, to make sure I didn't forget anything. What didn't I ask you that you wish I had you that you want these? Because I have so many things running through my mind, so I'm gonna let you kind of say what I might have missed.
So I would ask, is this too good to be true? What's the IRS going to think of all of this? Am I raising red flags? Am I inviting the IRS to come in and audit me? And the answer is no. Some of the strategies that we recommend for clients can actually reduce their risk of being audited by 90% or more. Simply switching your business entity from a single member LLC that's taxed as a proprietorship to a single member LLC that's taxed as an S corporation can cut your odds of being audited by over 90%. There are some strategies that we recommend that have no impact on your audit odds. There are some strategies that we recommend that can raise your audit odds. And when we introduce those strategies, we're going to say, here's what the IRS will look for if they audit you. And the client can either say, that's something I feel comfortable with, or, you know what, I don't feel comfortable with that particular strategy. Great. This is why it's better to be me than to be a hitman, because I got 49 other strategies that I can show them. And it doesn't mean that I am right and they are wrong. I'm not trying to prove anybody wrong. I'm trying to find the best fit. And finding the best fit doesn't involve judging someone for not being comfortable with a different fit. It's like in investments. Some people buy whole life insurance, other people buy crypto.
Right.
I have permanent life insurance. I like that my cash value can't go down. And the only thing I know about crypto is you can't spell crypto without cry.
Right.
Does that mean that I am wrong? No. I have clients who buy crypto and who have made a freaking fortune riding the swings up and down. It's just not the right fit for me. That's all. But I will happily help them pay less tax on the income they make from their crypto.
Yeah, that's brilliant. I think that you just have to, like if you're at point A, you want to get to point B, which I call financial freedom. There are obstacles in the way, and you want to kind of have a strategy that kind of knocks out or reduces those obstacles, so you have a smoother ride to get where you want to go. That's how I see it. I see it in like, it's not linear, but all right, I'm here. I want to get to here.
Right.
What's is keeping me from doing that? What is a drag on doing that? And that's how I look at this. It doesn't matter where you are. You just have to. And the other part of that, if you want, with the audit thing, is that if you are doing your books right, it doesn't matter. Is that
Yeah, I mean, so most audits, the IRS just wants to say, hey, did you report the right numbers to us? And if you've got the right books, if you've got good, clean bookkeeping, which is not a commodity, then you're going to be fine. Other audits center on whether a strategy is valid or not. For example, the IRS is auditing every syndicated conservation easement partnership that was formed in the last 1,000 years. And their argument is the strategy itself is abusive. So that's two different things. One, legitimate strategy, are your numbers correct? Or you're claiming real estate professional status that requires 750 plus hours in real estate in a year. Show us your times, show us your schedule, show us that you worked the 750 hours. So that's legitimate strategy. Did we comply with the strategy? The second set of audits is going to look at something and they're going to say, is this truly a legitimate strategy? And that's what's happening with the conservation easements. In some cases, the IRS is winning. Most of these cases end up in tax court. In some cases, the IRS wins. In a couple of recent high-profile cases, the IRS has lost.
Okay.
In one case, and this will be entertaining for everybody who is dipping their toe into artificial intelligence. In one case, the IRS used artificial intelligence, and the artificial intelligence hallucinated results. And it cited cases that don't exist. So naturally, the judge said, no, you don't get to do that. And the IRS lost. Now, you can say they lost on a technicality because they did lose on a technicality, but that's a pretty big technicality.
For sure. For sure. That's it. It's like, what? So a lot of people are, including even today, I've learned more, are just plain, and this is on purpose, afraid of the IRS. That's on purpose, but
very much so.
Should they be? Why is that? And should they be as afraid as they are?
Well, but they shouldn't be that afraid, because the IRS does not have the resources to go chase after everybody, to audit them, or even to collect the tax if they discover that somebody didn't pay their full tax. At the beginning of 2025, there were 103,000 people working for the IRS. Now that's down to about 80,000. So came in, Doge made buyout offers to experienced agents, and it fired anybody who had less than a year of experience. The IRS just doesn't have the manpower and woman power to come chasing after you. The proposed new IRS budget for next year is $1 billion less funding. Now, I understand that everybody resents the IRS because the IRS is the face of collecting taxes. But the IRS does not make the rules. Congress makes the rules. The IRS follows Congress's rules, and the IRS is a customer support organization. If you have a couple of W-2s and a mortgage interest statement and some receipts from charities and you file your taxes, you want to get your refund back as quickly as possible with no screw-ups. So most of the IRS budget goes just towards regular customer service. And don't you want that regular customer service to be as quick and efficient as possible? Well, if you do, it takes money. It takes budget, and Congress is not willing to fund the IRS to the level they want to.
So, it's funny because the pendulum swings back and forth depending on who's in office. So, I would, in my mind, I'm like, all right, let's, do what we can do, cross our I's and dots our T's, and just, don't do anything fraudulent and keep it moving. I don't think, most people are not like, what I was not liking about the last administration, it was assuming that people were cheating on their taxes for the most part. That was the message, the overall arcing message that I got out of that. And we're going to hire, this panicked me, 80,000.
Well, that was nonsense.
Yeah.
And you know better than that. There were never going to be 80,000 new gun-toting IRS agents. Part of the problem with IRS funding is that people who don't like the IRS take information and they misstate it. So the IRS got authorization to spend $79 or $80 billion over the next 10 years. We did not actually spend that money. Congress changed the law to say the IRS was authorized to spend this amount. We're now going to authorize them to spend up to $80 more. But the way the federal government works is first you've got to authorize the spending, then you've got to actually appropriate it every year. So the Republicans who were controlling Congress zeroed out that funding. The second thing is people said, oh, well, what are you going to do with that $80 billion? Well, we're going to hire 80,000 agents over this period. Well, most of that hiring was simply going to replace people who were retiring from the IRS over that next 10 years. But someone online, on X or on Instagram, decided, I'm going to get a lot of attention if I say that the IRS has just been authorized to hire 80,000 gun-toting agents. No, the IRS has about 2,000 gun-toting special agents. They don't wear their sidearms every day when they go out to visit people that they're investigating. And in fact, you talk about what the last administration did. Well, what this administration did was it took IRS special agents who are trained for tax crimes, and it put them on immigration, and it put them on patrol duty with police in Washington, D.C. So this is not just a one administration thing versus another. It's not partisan, and I don't want to get sucked into some red-blue binary.
Yeah.
This is government, and nobody trusts the government to spend their money. This is why we're having the discussion about tax in the first place, so that your money is not going to this chaos.
And I was at a conference with Tom Wheelwright. He says, look, code is another word for map. It's a treasure map. And so if you do what the government wants done, you will minimize your taxes. And I always tell our clients.
Tom Wheelwright he's in the space with me. I've never met him, but he is a sharp guy. I have a lot of respect for him. And what he says is worth listening to.
Yeah. Yeah. And he's, so it's that. So I'm a nerd. So I pieced together all this stuff. And I was one of those people that was terrified when that news came out. So I wish I had known you then, because I might have, I don't know what I was, but it caused me a lot of anxiety, even though we weren't wrong, but it's just like, oh, what? So that's good to know. And so I say that because there's other people that think like that. Oh, I haven't filed my tax in 3 years. And, you just got to get it done.
Mhm.
And it's not as, you got to be compliant, right? You got to start with that.
Get it done. Get it done, and things are going to work out better for you if you go to the IRS with those 3 years return. Because if you don't pay your tax in a long enough time, they'll send somebody to your house.
Yeah. Yep. For sure. So you don't want
And
that.
that's going to be scary.
Yeah. So, Ed, listen, I want to be respectful of your time. I thank you. This was a lot of fun. And what we're going to do, I have let me see if I can hold up. I have a book that he and I have worked on together called How to Beat the IRS Legally. I got to figure out how I'm going to get it out there. I might do like a free plus shipping and mail it out. And so we'll work that and put that in the show notes. And then if you go to our financial GPS strategy session, we can have a short call, and then we can talk about this, and then I can connect you to the appropriate people if we find that this is what you need to do.
Yep.
Okay. So guys, I want you to go out there and make some money. Let's keep more of what you make, and let's earn more on what you keep. Go out there and make it a profitable day.
Thanks so much. I'll look forward to coming back someday.
Yes, someday soon.